Let's get more on this now with Farah Murad in Dubai. She's a senior market analyst at Equiti Group. Good to see you, Farah. Now, it's been a week full of rate cuts for China. How significant are these measures in spurring growth in the country?
Thank you, Taiba, for having me. I believe China is finally ready to be serious about reviving the economy. Now that the federal bank, they moved away from their hawkish stance. Previously, we saw some modest move from China. The main worry was more stimulus, lower interest rate would add more pressure on the yuan, which wasn't really something they could support at the moment. So given this 50 basis point surprise rate cut from the Fed, I believe now we will see even more. Yes, as you said, we saw lower interest rate. We saw a push for companies to buy back their shares. This 1 trillion stimulus, I think it's a really good step. It's not enough. Some voices in China, they're speaking about 10 trillion yuan, which is almost 1 trillion. It would dwarf what we saw before, maybe during the crisis of 2008. But compared to what we saw from the US, 3 trillion, I believe it's fair. We still believe that China's market is kind of interesting because of a lower valuation they have at the moment. Maybe picking and choosing some sectors would be the smartest move for investors, but I believe we will see more aggressive moves from China. It's still not the end of it. We will see more, and it's still a high risk, high reward market.
And can we expect some more stimulus measures in the near future?
Yes, that's what I'm saying. With lower, weaker dollar, I believe that now there's more room for China to introduce and inject more liquidity in the market, lower mortgage rate, supporting lending. I think the main thing they need to focus on is consumption. Consumption is almost over 80% of the GDP. And with the target of 5% growth, they really need to support that, especially when it comes to lower middle income. I think this is where they need to work the hardest. And I think it's really too early to say that this is it. We will see more stimulus. I think the question is how it would be targeted. And that's what the investors and market would care about the most.
Meanwhile, China's industrial profits plunged by more than 17% in the latest reading. What's behind the fall in China's manufacturing growth?
I mean, sometimes the title can be misleading. It is definitely not a good data, especially compared to the previous ones where growth was really good. But then again, we're comparing it a yearly comparison, and previously last year in August we had really good growth, so definitely there's this base effect. Now also, if I want to check some details of this report, yes, we do have some industries showing lower growth, especially when it comes to mining, maybe oil industry as well. But then again, we have some industries that are gaining, and this emphasized the point that our exposure to China should be more selective. Manufacturing was doing good. State-owned companies, they were doing not so much, but companies related to Taiwan, to Hong Kong, they showed good gains. So I still emphasize on the point, our exposure to China should we shouldn't shy away from it, but also we should be selective, especially on maybe industries that are related to international markets.